Something broke last night. While you were sleeping, while most traders were offline, while the world was distracted by political theater, silver did something that shouldn't be possible in a functioning market. It didn't just rally. It didn't just break resistance. It exploded $5.80 in less than 24 hours, blasting through every technical level, triggering cascading stop losses, and forcing major financial institutions into positions they cannot escape. Ladies and gentlemen, the metal guy here. It's January 23rd, 2026, 9:47 a.m. Eastern Time. And I'm recording this emergency video because what happened overnight represents a fundamental shift in how silver is traded, valued, and controlled. The price touched $99.15 per ounce in Asian trading. That's within $1 of the psychological 100 barrier that analysts have been warning about for months. But more importantly, the way it moved, the velocity, the volume, the pattern, reveals that we've entered a new phase of this bull market. This wasn't retail investors piling in. This wasn't speculative momentum traders chasing gains. According to verified reports from multiple commodity analysts, what we're witnessing is forced buying. Industrial users who cannot wait for prices to cool, major institutions demanding physical delivery instead of rolling paper contracts, mining companies receiving offers $10 above market price just to deliver silver immediately, and the banks, the ones who've been shorting silver for years, the ones who've sold paper contracts they don't have metal to back, the ones who've profited from suppressing prices, they're trapped. Because when silver crosses $100, when the squeeze intensifies, when delivery demands accelerate, the entire fractional reserve system in precious metals collapses. So in this video, I'm going to show you exactly what happened in the last 24 hours. I'm going to explain why this 580 move is different from every other silver rally you've seen. I'm going to prove with verified data that the banks are cornered. And I'm going to tell you what comes next. Because $100 is not the top. It's the beginning of a repricing that could take silver to levels that would have seemed impossible just 6 months ago. Let me start with the exact timeline, because understanding how this unfolded reveals the mechanism behind the explosion. According to verified market data from multiple exchanges, silver closed Asian trading on Wednesday, January 22nd, around $93.35 per ounce. That was already a record high. The metal had been grinding higher for weeks, testing resistance, building pressure, but overnight, something changed. According to reports, silver opened Thursday morning in Sydney at 93.50 and immediately gapped higher. By the time London markets opened, it was trading at $96.80. And in early New York futures trading, it spiked to $99.15, an intraday gain of $5.80 from Wednesday's close. That's a 6.2% move in less than 24 hours, on a commodity that typically moves 1% to 2% in a normal session. On a market with deep liquidity and sophisticated participants who are supposed to smooth out volatility. But here's what makes this different from a normal spike. According to commodity analysts tracking the physical market, the move was accompanied by something that almost never happens: massive premiums for immediate delivery. One verified report cited a Canadian mining company receiving offers of $10 above market price just to deliver silver immediately. $10. On a metal trading at $95, someone was willing to pay $105 to get physical bars right now instead of waiting for standard delivery timelines. That's not speculation. That's panic. That's industrial users realizing that the physical market is so tight that they have to secure metal at any price or risk shutting down production lines. Now let me show you the forces converging to create this explosion, because this isn't about one catalyst. This is about multiple structural pressures hitting simultaneously. Force number one, the fifth consecutive year of supply deficit. According to verified industry data, 2026 marks the fifth straight year where global silver consumption exceeds production. The world is using more silver than it mines. And that deficit isn't small, it's massive. According to market analysis, the cumulative deficit since 2021 is approaching 900 million ounces. That's equivalent to nearly one full year of global mine production. And where does that metal come from? From above ground inventories, from stockpiles, from vaults. But according to multiple reports, those inventories are depleted. Exchange-registered silver, the metal actually available for delivery against futures contracts, is down 70% from 2020 levels. Private dealer inventories are thin. Mints are reporting 8-week backlogs on basic bullion products. The supply shortage isn't coming, it's here. And when shortage meets surging demand, price is the only adjustment mechanism. Force number two, industrial demand that cannot wait. This is the piece that changes everything. According to industry analysis, silver's industrial applications have exploded. Solar panels consume over 25% of annual global silver supply. Electric vehicles require significantly more silver than traditional cars. AI data centers need silver for high-speed connectivity and power management. And here's the critical point: manufacturers cannot substitute. Silver is the most electrically conductive metal on Earth. There's no replacement for solar panel production. There's no alternative for high-performance electronics. You either secure silver or you shut down production. According to verified reports, this creates what analysts call forced buying. Even as prices climb, demand doesn't fall. That breaks the normal supply-demand feedback loop that usually caps rallies. When a solar panel manufacturer needs 50,000 ounces per month to keep production running, they don't care if silver's $90 or $99 or $105. They need the metal. So they pay whatever price the market demands. And that price-insensitive buying pushes markets higher regardless of technical levels or traditional valuation metrics. Force number 3, China's export controls. According to verified reports, China implemented export licensing requirements for silver effective January 1st, 2026. That policy effectively cut off a major source of global supply. Silver that enters China cannot easily leave. The export process requires government approval, and that approval is being denied or delayed. According to market analysts, this has fragmented the global market. Prices in China are divorced from prices in Western markets. Arbitrage, the mechanism that normally equalizes prices across geographies, has broken down. And Western buyers, who were counting on Chinese supply, they're now scrambling to source metal from other regions. That's driving premiums higher. That's creating the physical shortages that are forcing industrial users to pay 10 above spot for immediate delivery. Force number 4, institutional investors demanding physical delivery. This is the smoking gun. According to verified reports from multiple analysts, something fundamental has changed in the futures market. Historically, most silver futures contracts settle in cash. The buyer and seller agree on a price difference, exchange money, and nobody takes delivery of actual metal. But according to recent data, large players are no longer settling in cash. They're standing for delivery. They're demanding physical bars instead of paper profits. According to one market analyst tracking delivery patterns, when too many traders ask for real metal at the same time, exchanges are forced to source bars at almost any price. That's exactly what's happening. The exchanges, which operate on fractional reserve principles, holding far less physical metal than the paper claims outstanding, are facing a liquidity crisis. They need to find metal. And in a tight market, finding metal means paying up. Force number 5, major banks. Floating triple-digit price targets. According to verified reports, major financial institutions that typically downplay precious metals have started publishing bullish silver forecasts. One institution projected prices between $100 and $110 per ounce. Another suggested a range of $135 to $300 for 2026. These aren't fringe analysts. These aren't gold bug promoters. These are mainstream institutions with massive research departments, sophisticated models, and access to data the public doesn't see. And according to the reports, their forecasts are not based on hype cycles or retail speculation. They are based on inventory data, industrial demand trends, and physical market stress. When institutions that profit from the status quo start warning clients that silver could hit $300, you know something fundamental has changed. Now let me show you why the banks are trapped, because this is the part that most people don't understand about how the silver market actually works. The paper silver market operates on leverage, futures contracts, ETF shares, allocated accounts. All of these create claims on silver that far exceed the physical metal actually in vaults. According to industry estimates, the paper-to-physical ratio in silver is somewhere between 51 and 100. 1. That means for every physical ounce, there are 50 to 100 paper claims circulating. This system works perfectly as long as only a small percentage of claim holders ever demand delivery. As long as most contracts settle in cash, as long as ETFs don't face redemption waves, the fractional reserve can sustain itself. But what happens when that changes? What happens when industrial users start demanding delivery? What happens when institutions decide they want physical instead of paper exposure? The banks who sold those contracts, who collected premiums for selling call options, who went short on futures, who issued allocated accounts without holding corresponding physical, they face unlimited losses. Because unlike stocks, where short positions are capped at 100% if the company goes to zero, commodity shorts have no ceiling. If silver goes to $150 or $200 or $300, the losses compound exponentially. And here's the trap. To cover their shorts, the banks need to buy physical silver. But where do they buy it? From a market where dealers are paying $10 premiums for immediate delivery. From a market where registered inventories are depleted. From a market where industrial users are competing for every ounce. The banks are caught in a death spiral. As they try to cover, they push prices higher. Higher prices trigger more delivery demands. More delivery demands force more covering. And the loop accelerates. Let me show you the specific indicators I'm watching that confirm this isn't a normal rally. This is a structural break. Indicator 1, backwardation. According to market data, silver futures have entered backwardation. That means near-term contracts cost more than long-term contracts. In a normal market, that's reversed. Long-term contracts should be more expensive because of carrying costs, storage, insurance, interest. But when near-term contracts are more expensive, it means people are desperate for immediate delivery. They're willing to pay a premium to get metal now instead of waiting. According to one analyst, silver futures entered deep backwardation, a phenomenon last seen at the peak of the 1980 bull market. The 1980 bull market, that's when silver hit $50 per ounce, equivalent to over $180 today when adjusted for inflation. Backwardation at that level signaled that the physical squeeze had reached its climax. We're seeing the same pattern now, and we're only at $99. Indicator 2, lease rates, spiking. According to verified reports, silver lease rates, the cost to borrow physical metal, have spiked dramatically. When lease rates surge, it means physical holders are demanding high compensation to lend their metal. Because they know it's scarce, they know getting it back might be difficult. High lease rates are mathematical proof of shortage. They can't be manipulated away with paper contracts or verbal reassurances. They reflect the reality of physical availability. Indicator 3, premiums widening. According to dealer reports and analyst observations, premiums on physical silver products have exploded. Standard bullion rounds that normally trade 2 to 3 over spot are now 6 to 8 over spot. Government coins are $10 over spot when available. And according to that verified report about the Canadian miner, someone offered $10 above market for bulk bars. That's unprecedented. That's the kind of premium you see when shortage becomes crisis. Indicator 4, ETF inflows accelerating. According to market data, silver ETF inflows turned positive after nearly 2 years of outflows. Institutional money is flooding back into silver, not for short-term trades, for strategic positions. When institutional money shifts direction, it doesn't reverse quickly. These are large allocations based on fundamental views. They're positioning for sustained higher prices. They're betting the structural shortage can't be resolved quickly. Now let me address the obvious question. Is this sustainable? Or is silver going to crash back to $80 like it has after previous spikes? Here's why this time is different. And I know everyone says this time is different right before markets prove them wrong. But let me show you the specific factors that make 2026 silver market structurally distinct from previous rallies. In 2011, when silver hit $49, the move was driven primarily by speculative momentum. Retail investors piled in, hedge funds went long. It was a classic parabolic blow-off. And when the trade got crowded, when margin requirements increased, the leverage unwound violently. Silver crashed back to $26. But 2011 didn't have a 5-year structural deficit. It didn't have China's export controls fragmenting the global market. It didn't have AI data centers and electric vehicle manufacturing creating locked-in industrial demand. It didn't have central banks starting to accumulate silver as a strategic reserve. The 2011 rally was built on sentiment and leverage. The 2026 rally is built on supply-demand fundamentals that CA can't be solved with margin hikes or short-term price suppression. According to one market strategist, the setup for 2026 is fundamentally different from previous cycles. Silver enters the year with a 5-year deficit, elevated industrial demand, sovereign accumulation, and a jump in investor participation not seen since the early 2010s. Could we see a correction? Absolutely. Markets don't move straight up. Silver could pull back to $90 to $85, maybe even $80 before resuming higher. Volatility is normal, but the underlying shortage doesn't get resolved by volatility. The industrial demand doesn't disappear. The sovereign buyers don't stop accumulating. The deficit doesn't turn into surplus overnight. So corrections are buying opportunities, not reasons to exit, not signals the rally is over. Let me show you what major analysts are forecasting, because these targets matter. According to verified reports, major institutions are projecting $100 to $110 per ounce as near-term targets. One institution suggested $135 to $309 as the range for 2026. Technical analysts see long-term potential for $400 based on historical patterns and supply-demand math. Industry CEOs are publicly stating triple digits is definitely on its way. These aren't promotional forecasts from silver promoters. These are research notes from institutions that manage trillions. They're based on inventory data, industrial consumption trends, monetary policy expectations, and geopolitical analysis. And here's the critical insight. Even the bearish forecasts are bullish. The lowest target I've seen from mainstream institutions is $100. Nobody credible is calling for silver to return to $50 or $60. The debate is whether it stops at $100 or runs to 200 plus. When the range of forecasts is $100 to $300 and you're buying at $99, the risk reward is asymmetric. The downside might be 10% to 15%. The upside could be 100% to 200%. Let me address your personal situation because that's what matters most. If you own physical silver, don't sell. I don't care that you're up 50% or 100% or 150%. This rally is based on fundamentals, not speculation. The shortage is real. The industrial demand is locked in. The sovereign buying is strategic. This isn't a trade. This is a repricing. According to one analyst, in an age when paper silver's credit is in doubt, only physical silver can be trusted. Hold your metal. Ride through volatility. This is the position you've been waiting years to have pay off. If you own paper silver, ETFs, futures, understand your counterparty risk. If the squeeze accelerates, if exchanges can't deliver physical, you might get cash settled at prices below where physical trades. The gap between paper and physical could widen dramatically. Consider converting paper exposure to physical while you still can. The premiums are high, the delays are long, but having metal in hand eliminates the risk that your paper claim becomes worthless in a system-wide failure. If you don't own silver yet, the question isn't, is 99 plus too high? The question is, where will it be in 6 months? If the target is $150 or $200 based on structural shortage, does it matter whether you bought at $80, $90, or $99? You're still capturing the majority of the move, but act fast. According to dealer reports, inventory is disappearing. Products that were available yesterday are sold out today. Premiums are widening. Delivery timelines are extending. The people who will regret their decisions aren't the ones who bought at $99. It's the ones who waited for a pullback to $85 that never came, then tried to buy at $120 and found dealers sold out. Let me close with one final thought that connects everything. The 580 explosion in 24 hours isn't just a price move, it's a signal. It's the market screaming that the paper system is breaking, that fractional reserves can't survive when claim holders demand delivery, that industrial users will pay any price to secure supply, that sovereign nations are treating silver as strategic infrastructure, not as a tradable commodity. According to one comprehensive analysis, silver is shifting from an industrial metal with some monetary flavor to an asset with three co-equal identities: industrial input, monetary metal, and strategic material. That triple identity, industrial, monetary, strategic, is unprecedented, and it means silver's valuation framework has permanently changed. Future prices won't be dictated by simple supply-demand. They'll be determined by geopolitics, by monetary policy, by strategic reserve decisions. The banks who are short don't understand this yet. Or maybe they do, and that's why they're trapped. Because you can't short a strategic asset that governments are hoarding. You can't suppress prices on a metal that manufacturers need at any cost. You can't maintain fractional reserves when everyone demands physical. The system is breaking, the paper game is over, and the repricing has only just begun. This is the Metal Guy from Currency Archive. It's Thursday, January 23rd, 2026, 9:47 a.m. Eastern. Silver exploded 580 in 24 hours, hitting 90 to 1.15. Major institutions are projecting $100 to $300. Industrial users are paying $10 premiums for immediate delivery. Futures are in backwardation. Registered inventories are depleted. The banks are trapped. The shortage is real. And the $100 level is on resistance. It's the starting line for a rally that could reshape precious metals markets for a generation. If you're holding physical, don't sell. If you're holding paper, consider converting. If you're not positioned, understand that the window is closing fast. The price you see on the screen might say 99, but the price industrial users are actually paying is 109. The price that reflects true scarcity, the price that will eventually become the official price when the paper market admits it can't deliver. This is the Metal Guy. The explosion has begun. The banks are cornered. The system is breaking. Position accordingly. Do it now.